Okay, so in this video I'm going to do some problems that you will see in these are sample problems similar to what we'll see in exam 1. Keep in mind that this is not everything that will be in exam 1. It's just some sample problems. I try to do most of the problems in this video, and a lot of the conceptual stuff you'll just go to the review sheet and you'll have most of the conceptual stuff. Okay, so I'm just going to review some of the sample problems that you're going to have on the test. So these are very similar, not exactly alike, but they're very similar. Okay, so let's take a look at the first one. First one says if operating cash flows equals 12,000, assets equal 750,000, liabilities equal 450,000, and the firm received $100,000 from the issuance of a bond, what is stockholders' equity? Well, this question is a little bit misleading, okay, because it's giving you more information than you need. In order to calculate stockholders' equity, all you need is assets and liabilities, okay? So you could ignore operating cash flows and you could ignore the $100,000 from issuance of bonds, right? If you recall, the formula for the balance sheet equation, the accounting equation says that assets equals liability plus stockholders' equity, right? So if we know that we have assets of 750,000 and liabilities of 450,000, what's stockholders' equity? Very simple, 750 minus 450, right? Assets minus liabilities equals stockholders' equity. It's the same thing. You just do a little bit of algebra here, right? So 750 minus 450 is 350, okay? Remember, assets is everything that the company has, and liabilities is stockholders' equity is how are they financed, who owns a portion of each. So of all my assets, of the $150,000 in assets that I have, 300,000 is all paid for by me, and 450,000 I owe to other individuals outside the company. Those are my liabilities. That you could view as liabilities and stockholders' equity as to how the assets were funded. Okay, so as an owner, as a common shareholder, I own $300,000 of my 750,000 in assets. Okay. Remember the example of the house. If you have a house that's worth $750,000, and you paid the bank $300,000, you still owe the bank $450,000, right? That's your mortgage. Or another way to put it, if the house is worth $750,000, but you have a mortgage for $450,000, your equity is $300,000, right? Equity is what you actually own of the whole thing that the company is made of, or in this case, in my example, of the house, right? So this question was very easy. You're going to have to remember this formula, and you could also apply a little bit of algebra. So the algebra that we applied here is that assets, oops, let me make this black. Assets minus liabilities equals stockholders' equity, right? It's the same thing as this up here, but with the variables shifted around. Okay, so let's go ahead and do another problem. Okay, this says a firm's statement of changes in stockholders' equity shows an ending total stockholder equities balance of $110,000 at the end of 2015. In 2016, the company issued new shares for common stock of $60,000, reported a net loss of $5,000, and paid dividends and paid $4,000 in dividends to their shareholders. The firm's 2016 statement of changes in stockholders' equity will show an ending stockholders' equity balance of, okay, so there's two main formulas that we have to remember. I already mentioned one in the in the first problem, that assets equals liabilities plus stockholders' equity, right? So stockholders' equity is the portion of your company that you actually own, right? That part, that's mine, that I paid for. Okay, how does equity change? Well, equity changes various ways, right? You start with beginning equity. Then to that if you bring in more money, then that's going to increase equity, right, with new shares. If you repurchase some of those shares, that's going to take out the equity that's out there. If you pay your shareholders dividend, that's going to take out the equity. And of course, if you make net income, well, that increases your equity. If it's a net loss, it's going to decrease your equity, right? So this is the equity formula. Ending equity is going to equal beginning equity plus any new shares issued minus any shares repurchased minus any dividends given to the common shareholders plus net income. If it's a net loss, you subtract it, okay? So let's prepare this little chart here to see if we can get our answers. Let's see how I organize this. Okay. So let me just put all the numbers there, okay? So this says a firm statement of change holders and stockholder equity shows an ending total stockholder equities balance of $110,000 at the end of 2015, okay? So at the end of 2015 you had 110, then obviously on January 1 you started off with 110,000. That's what you started off with, right? It says the company issued new shares of common stock for $60,000. So that adds to your equity. That's more money that came in. Okay. Reported a net loss of $5,000. We'll put it here as a negative. And paid $4,000 in dividends. If you pay out $4,000 in dividends, that's going to reduce your equity. Okay. So it's saying what's my ending equity. So this is very simple, right? They're asking for this here. All you have to do is take 110, add 60, subtract 4, and subtract 5. And that'll give you your answer. Okay, and the answer will be 161,000. So remember, memorize this formula here, and you can solve this problem very easily. Okay? Let's go ahead and do a couple other problems. This one here is problems on some ratios. Okay, here we have balance sheet section. These are averages, and here you have the income statement. And so we're going to do some ratios here. Return on investment is a very simple ratio that tells you how much money you make per average total assets that you have, that your company has. Your total investments, regardless of whether it was financed, if it's financed with equity or liabilities, it's the whole thing. So it's your return on investment, right? So this is quite simple. You're going to take your net income and you're going to divide it by your total average assets. And so in this case, the answer is going to be 12%, right? Net income divided by average assets will give you your return on investment. You could also get the same answer by using the DuPont model. The DuPont model calculates return on investment, but it does it by combining two other ratios, the margin ratio and the turnover ratio, right? The margin ratio is net income over sales, and the turnover ratio is sales over average total assets, right? So let's go ahead and calculate the margin ratio first. We'll do it up here. The margin is going to be equal to net income, which is over here, divided by sales, which is where's my sales? Over here, right? And that's going to give me this over here. Let me go ahead and delete all this so that I could do it from scratch. Okay, So that's my margin. So let's do the turnover. The turnovers, we'll put the turnover over here. And turnover is going to be equal to sales divided by average assets. So that's my turnover. So now if I take this and multiply it by this, I will get my answer. And it should match the same answer that I got over here, which is 12%. Okay, this times this, and the answer is going to be 12%. Okay, so the DuPont model, remember, it's a combination of the margin ratio and the turnover ratio. Margin ratio times turnover ratio. It should give you return on investment. It's another way of calculating return on investment, and it's basically tells you how many times you're able to turn over your margin on per sale, and that'll give you your total return on investment. Okay, return on equity is a little bit different. Return on equity is similar to return on investments, except that you're going to calculate it based on only the equity that you put up, only the money that you put up. Okay, so that's going to be equal to net income divided by average total equity, the 210 over here. Again, I have to, and that's going to be 17.14%. Okay, let's take a look at some liquidity measures. Okay, working capital, current ratio, and asset test ratio are liquidity measures. It measures how much cash you have, how liquid you are, you know, in case you get in trouble, how much cash you have on hand. So one ratio is working capital. Working capital is simply current assets minus current liabilities. What are current assets? Well, current assets are assets that are converted into cash during the operating cycle of a company. You have cash, you have inventory, you have accounts receivable is the current assets. Some prepaid accounts are current assets if they're going to be used up within a year. What else is another current asset? Inventory, accounts receivable, cash equivalents, and highly liquid short-term investments that are maturing within 1 year. Okay, those are all current assets. Okay, in this case we only have two that are current assets, right? Cash and inventory. Okay, so let me go ahead and put my current assets here. My current assets are cash and inventory. Okay, and my current liability is CL. Current liabilities are the liabilities that are going to be used up within 1 year or the operating cycle, whichever is longer. Okay, in this case, accounts payable is the only one that qualifies as a current liability, right? So my working capital is current assets minus current liabilities, which is going to be 180. Okay, so my working capital is 180. If I am to pay off all my immediate liabilities, which in this case would be only accounts payable, I still have 180 in current assets, so I'm fairly highly liquid. Okay, the current ratio is very similar to the working capital, but they use a ratio instead of one minus the other. Okay, so it's very simple. All you do is use a ratio. Current asset divided by current liabilities. Okay, so I have 460% more current assets than current liabilities. That's a pretty high ratio, right? Not sure if it's expressed. It could be expressed like this as well. The ratio 4.6 could also be is the ratio. So the current ratio could be 4.6 in this case. And then you could do the asset test ratio. The asset test ratio is similar to the current assets, but it uses the more highly liquid assets. And there's two that are the more highly liquid current assets, and there are two that qualify for that, for quick assets: cash and accounts receivable. In this case, we don't have accounts receivable, but we do have cash. So we have $50,000 in cash, and we're going to go ahead and divide that by my current liabilities, which is, so the ratio is going to be equal to 50,000 minus 50,000, and of course, you guessed it, in percentage terms we could say 100%. In single digit terms we'll say 1. Okay, so that's it for those formulas. Just remember these formulas and memorize them for the test. Okay, let's do the next one. This one here is on accruing interest. Okay, so let's read the problem. It says on December 1st, let me go ahead and delete all this and I'll start from scratch. So on December 1st, 2016, Carlson Corporation purchased $90,000 treasury note. Okay, so they purchased a treasury note. They bought the note. That means that they gave the money, which means that they will be receiving the interest, right? Okay, so they purchase a note for $90,000 that pays them 12% interest. Okay, they're going to receive the 12% interest plus their $90,000 back on November 30th of 2017. So they'll receive it after a year, right? Carlson's fiscal year ends December 31. What accounting entry will Carlson do on December 31st? Just because they received their $90,000 cash on November 30th plus the interest, that doesn't mean that they going to do an accounting entry only on November 30th. They have to accrue for the interest that they've earned in the year that they've earned it, right? So how do we do that? Let's do this. Okay, so the note is for $90,000. So the note is for $90,000. That's the principal, 90, 1, 2, 3, right? Let's go ahead and format this, 90,000. And it says that the interest is going to be 12%. Okay, let's make this a percentage. The interest is 12%. Okay, so what's the annual interest? What's the total interest that they're going to earn on this? Annual interest is going to be equal to 90,000 times 12% is 10,800 for the full year, right? But they purchased this on December 1, and so they're going to accrue interest, the interest that they earned on December 31st. From December 1 to December 31st, how many months have gone by? 1 month, right? So you're going to accrue the equivalent of 1 month. What's the equivalent of 1 month? Well, 10,800 divided by 12, right? So every month you're going to accrue $900 in interest that you've earned, right? And that's going to be called interest monthly. We'll call this monthly interest revenue. Okay? Monthly interest revenue. Okay? Okay. So, let's just go through all the accounting entries. December 1st, I bought the bond, right? So I purchased a bond for $90,000. And Let's say I pay for it cash. So my cash goes out, right? Bond goes in, cash goes out. $90,000. Perfect. Now, this is December 1st. Now on December 31st, I want to let my investor know how much interest I've earned on that bond for this year, right? Did I receive the cash for this bond? No, I'm going to receive the cash on November 30th, but I still have to recognize the revenue for 1 month. I've already calculated that. It's going to be 900. So what I'll do is I'll book an interest receivable on December 31st, right? I'm expecting to receive this, and it's going to be for $900, and I'm going to recognize interest revenue on that month, $900. Okay, so that's the accrual of interest that I have for December 31st. On December 31st, I accrue 1 month of interest. Okay, now because the fiscal year ends December 31st, you have to do this entry here, because you want to recognize the revenue that you've earned in the period that you've earned it. So you've already earned $900 in interest revenue, therefore you must book it in the correct year, $900. Once November 30th comes by, you will receive your cash back, and you will go ahead and close the interest receivable over here. Okay, so that one is quite simple as well, and if you don't understand it, just ask me in class. Let's do the last one. Okay, let me go ahead and delete this. It says Smith Company received $24,000 cash advance as payment for an office it will lease for a full year, 12 months. What's the original entry at the end? What's the original entry and the entry at the end of the first month? Okay, so what's going to be the original entry? You received $24,000 in cash, right? So let's put 24,000 over here. That's what you received. Is that revenue for renting? Is that rent revenue? Absolutely not, because you haven't earned it yet. So what is that? If you receive $24,000 in cash, but you haven't earned it yet, you owe somebody $24,000. Now you could give them their cash back, right? You could pay them back their $24,000, or you could pay them back by providing the products or services that you promised. In this case, you're promising rent. You're promising the usage of of an office, right? So as your customer, the person that gave you the $24,000 uses the office, you will be earning your money. So it says this is for a full year, 12 months, and they pay you $24,000. So how much are you charging them per month? Well, that's easy. 24,000 divided by 12, you're charging them $2,000 a month, right? So you're going to earn $2,000 a month, but you haven't earned it yet. So the original entry, you got cash, and you have a liability. Unearned rent revenue is a liability. Why is it a liability? Because I owe this customer $24,000. I could either give it to the customer back in cash, or I could give it to the customer back in whatever I promised them, product or service. Okay, so the original entry would be something like this: cash, 24,000, and then unearned rent revenue, 24,000. Okay, that's the original entry. Okay, So as every month goes by, as you saw, we earned $24,000. So when 1 month goes by, at the end of the first month, you recognize $2,000 in rent revenue. Sorry, revenue has a balance on this side, right? $2,000 in rent revenue, and you reduce your liability. You no longer owe this customer $24,000. So you lower it by $2,000 every month, right? So the entry is going to be equal to, you're going to lower your unearned rent revenue by $2,000 and you are going to go ahead and recognize rent revenue, because now you've earned it, by $2,000. Okay? You're going to do that every month until you've earned your full $24,000, right? So you're going to do that for 12 months. Okay. So once you do that for 12 months, can't remember, let's see if this is 12 months. 18, I guess this is 12 months, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So once you do that for 12 months, you're going to lower this for the full 24,000. You'll no longer have a liability. This will close at zero. Let's move this aside just so that you can see it. So you do 12 here as well, right? Let's see, right? 12 months here, it's 24,000. So what's going to be your balance at the end of 12 months? Your balance is going to be zero, right? 24,000 on the asset side, 24,000 in the liability side. You no longer on the debit and on the credit side, so now your balance is zero. You've closed this account and you've recognized $24,000 in revenue. Okay, but the question said, what was the original entry? This is the original entry, and the entry at the end of the month is this one, right? Every month you're going to do this entry. You're going to recognize a portion of your revenue. Okay, so those are our sample problems that are going to be in exam 1. They're not everything on exam 1. Study the review sheet and study the PowerPoint slides, and you should be okay with exam number 1. Thank you.